Chris, today we are going to be covering the 7 financial myths. And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for that common sense approach to planning with our money for our financial future and retirement. He is Chris McIntire, president and founder of McIntire Retirement Services. Chris, always a pleasure. Welcome back in.
Hey, good morning, Peter. Good to be with you.
It is good to have you along and to be with you, Chris. Always is, and you always cover some good information to help people in their planning progress and make sure that their money is working as hard as it should and could to help us achieve those long-term financial goals. And ladies and gentlemen, as part of the program, it's always your opportunity to get a plan put together or to review and evaluate your current accounts, investments, and plan. And Chris McIntire, your resource to do that. As an extension of this program, no cost, no obligation for that complimentary review and strategy session. Just pick up the phone and give a call, 800-868-1194, 800-868-1194. I always like to begin the show by reminding you have that opportunity, a valuable resource to get that plan reviewed or put together. Again, just give a call, 800-868-1194, or skip the phone altogether. Always available online at McIntireRetirementServices.com, McIntireRetirementServices.com, always available there. So, Chris, today we are going to be covering the 7 financial myths. Now, these are commonly held beliefs or maybe misconceptions about the financial world, but these are 7 items that a lot of people's plans and forecasts and projections, and therefore what our financial future is based upon, that we may need to re-examine or question their reliability.
Yeah, that's a good way to put it. There is, and what is the real math behind investments, because and I guess I'll give you an example is, you could have a dividend paying stock that's paying a 4% dividend, but the price of the stock can go down. Does that make any difference if you're living off of the dividend? Probably not. But obviously you want the price of that stock to go up. But, that's a different thing than living off of the growth of Amazon stock that doesn't pay any sort of dividend, right? To make money on it, the price of the stock has to go up. To make money off of a dividend stock, you have to have the dividend come in. So 2 different math equations there is kind of my example.
But to be a savvy, informed investor, Chris, we obviously need to understand what we are investing in and what component of our money we are counting and relying on, whether it's the growth, whether it's the interest rate, whether it's the dividend, whether it's guaranteed income. We have to understand the different components and what each dollar is doing for us. And that is, in fact, part of that review process, as well as the amount of risk that we are taking, the taxes that we may be liable for. You really bring all of those pieces together so people can see the full and complete picture.
Yeah. And part of our job is educating clients, and that's an ongoing process. We've had a couple of volatile years here. Obviously, we had COVID in 2020 and 2022. We had, a sharp rise in interest rates, which depressed bond prices, which depressed stock prices. And now here we are, most of the way through 2023. And one part of the market has done very well, and that would have been the growth sector. So if you would, been invested in the technology sector, it's been a rewarding year. If you were in the dividend-paying stock sector, it's been a lackluster year, I guess it'd be a good way to put that.
But that seems to be cyclical or like a teeter-totter, right, Chris? Because if we looked back at last year, those same stocks that are doing so phenomenal this year actually had one of the worst years last year. And over the course of time, it seems to relatively all evened out. But one had a lot of volatility, one didn't, right?
Yeah, no question about it. We were using Amazon stock as an example. It fell about 40% in 2022. Well, it needs to make 60% to get those investors back to whole. And it might be up 30, 35%, depending on what day you're looking at it and listening to the show or the podcast. So it's got a long way to go just to get, the investors back to whole, for example, and where dividend stocks don't have that type of typically don't have that type of pricing anomalies. They might be, in 2022, they actually held up pretty well. Okay. 2023, they've been, suffering from some of this interest rate increases there. And that will normalize itself out, obviously. And it's starting to here in the fourth quarter already.
Yeah, we'll call it relative underperformers, but again, that being all relative, they underperformed on the down as well, meaning they did not lose nearly as much. So again, all evening out depending on how you are allocated and diversified, and those are important factors that you need to understand about your money, ladies and gentlemen. And a lot of people don't. Unfortunately, it is a set it and forget it by and large kind of approach to, hey, let's just pick a few handful of mutual funds, especially in those 401ks, Chris. And hey, the market should always go up over time, so everything will be all right. And in fact, that is number one on our list here of these 7 financial myths, common planning mistakes or misconceptions to reconsider. Number one, that the market always goes up. And we've certainly seen periods where this has not held true, but yet so many people's financial future is sort of reliant on this.
Yeah, no question about it. The assumption that the market does go up over a course of time, obviously, and it can certainly disappoint you in certain segments of that overall graph, right? We've all seen charts of the S&P 500, the Dow, or the NASDAQ, and volatility is tough on retirees that spent their whole life putting money into the market, and now they're taking money out of their nest eggs, their IRAs, their 401ks, and it can be an emotional gut check, no question about it.
Chris, do a lot of plans really compensate for this fact that the market will be volatile? It will have cycles, that certain sectors may be down, not just for a short period, but sometimes for extended periods of time. Do you see that people's plans align with that reality?
No, not necessarily, and obviously as we, create income plans, investment plans for our clients, we have safe strategies, we have income strategies, we have some growth strategies in there. But the average person that invested in a lifestyle 2025 fund, for example, was probably disappointed in how it performed in 2022 because they have the mindset that, well, I'm going to retire in 2025, so this should be, probably a lot safer than what they had anticipated. And obviously, bonds took a big hit last year, stocks took a big hit last year, and even bonds this year had been underperforming significantly. So, we hit some unprecedented times here, going into COVID, and then on the other side of COVID from government, overstimulating the economy as a politically neutral statement.
So maybe the statement we need to make here, or the rethinking of this financial myth, Chris, it is sort of the widely held belief, or we may hear, that the market always goes up. It has gone up over time. And when it goes down, it has not only come back, but surpassed previous highs given a long enough investment time frame, right? But not in any specific time period necessarily or guaranteed.
Yeah, you're right. And are there certain patterns that develop over an economic cycle? We could make that argument for sure. Notwithstanding geopolitical events, right? Russia invading Ukraine is not part of an economic cycle. What has just happened in Israel is not part of an economic cycle. 11 interest rates in a row is not part of an economic cycle. So there has been, a lot of things to throw off the market here, coming out of the COVID era, if you will. But if you look at like the months of August and September this year, the markets were pretty disappointing. Historically, that's very normal, though. The market does typically pull back in September. Historically, it's one of the worst months for the market overall. And, we're early into the fourth quarter here, and we're, coming up, hopefully, 5 days don't make a rally, but hopefully we continue on this positive trend, which historically happens in the fourth quarter. So, you can find some patterns in there, but it's hard to just say, well, look, I'm going to sell every September and get out of the market and then get back in. Well, you certainly can't necessarily do that because you miss all the dividend payments and other things like that.
Chris, again, got to understand what's going on with our money, how it's positioned, what it's intended to do. But do periods of extended time, like the lost decade, for example, the 2000, the dot-com bubble bursting, the Great Recession, do extended periods of time where the market essentially moves sideways or up and down with a lot of volatility, do those times create more difficulties for investors and retirees in particular, or do we just keep plugging money away and take advantage?
Yeah, and if you're working, obviously you want to continue to put money in on a regular basis, Peter, because, you're buying more shares when those prices are down low. So, that's the nice thing about automatic investing on 401ks, for example, right? It dollar cost average in. When you're pulling money out of your portfolio and it takes a big correction, that's when you have to go back and look at, all right, are we taking out more than we need to from our portfolio? Should we slow down? Or should we alter our strategy and, come over to our safe money and make a withdrawal out of that and give our investment portfolio a little time to recover? I'd just say take some of the pressure off would be a good way to analyze that. So having many different strategies gives you more flexibility in times of volatility is a good way to summarize that statement.
Chris, Japan pretty famously peaked in their wave of the baby boom demographic in 1990, and at that time Japan had been considered kind of the marvel of efficiency, and their model was going to take over the world economically. But when they hit that peak of that baby boom demographic, pretty famously they suffered a downturn in their market, and it lasted for a protracted period. I mean, we are still not seeing the market above where it had peaked. Do we worry about that same kind of impact or effect hitting retirees in the U.S. and keep that in the back of our minds as we are planning for the worst, but preparing for the best, or hoping for the best rather?
It's it's an interesting topic there. You talk about Japan and their aging population that is ahead of our baby boomers. And, the analogy was, well, they're going to spend less money in their retirement. And, Japan had negative interest rates, very low growth for a long period of time. They're on the other side of that now. They're probably one of the brighter market pieces, going into end of 2023 and looking into 2024, as a matter of fact. They had to get their fiscal house in order because of the changing demographics. The United States has that same issue, is, the aging population. And I suppose we could probably talk about the strain on Social Security, the strain on Medicare, some of the entitlement programs that may, affect some of the financial, I don't want to use the word stability in the wrong place, but the ability of those entitlements to sustain themselves for the, given our government that can't quite get any issues solved. Sorry, I'm spitting and stuttering all over the place trying to find the right words there, Peter.
No worries, Chris. And I think that we need to look at other examples and situations and conditions, but the American economy has proven resilient, remained strong. Yes, we have faced those difficulties in periods before, but again, not only has the market always come back, it's always surpassed previous highs. But here's the myth or misconception that the market always goes up. That is not the case. And so, especially as you plan to make that transition or are living through retirement, your plan needs to be cognizant and recognize that fact, and the fact that the market's upward movement is not always reliably dependent. And that's why Chris McIntire puts together those diversified strategies with some safe money strategies to complement the growth and risk strategies, but not always relying on the market to produce some positive rate of return, which in fact, Chris, is myth number 2 on this list, that the market averages a 10% rate of return. And I think it goes deeper than that. A lot of people's plans and projections, they don't even rely on this average rate. They count and rely on that rate of return happening consistently and each and every year, which may be the bigger danger in relying on this myth.
Yeah, you're right, Peter. We show clients a lot of different types of illustrations on software programs and whatnot. And I'm always cautioning them, look, life is not an illustration. So when we build a life insurance policy illustrates a certain interest rate over the life of the policy. Well, interest rates can change over time. So, that may not be the than the intended outcome. Could be better, could be worse, is make a fair statement. But to get a 10% average means I lost 50, made 50, made another 30. That's a 10% average rate of return. But if you had $100,000, lost 50%, you've got 50,000, made 50%, you have 75, made another 30%, you're back to 100,000. Now, most of us listening to this show or working that math through our head are like, that's not a 10% rate of return. That's a 0% rate of return.
Right.
Exactly. And engineers would say there are, damn lies in statistics, right?
Yeah.
So, you can make math, math can be very funny from our federal government to the investment world. And, and we're not saying anybody's misleading you in the mutual fund industry or anything like that, but just, the real rate of return versus the average rate of return are two different numbers, obviously. And, if you had Amazon stock, for example, you lost 40% last year and you're like, okay, that hurt. But this year it's the highest one of the best performing stocks out there in the large cap sector. Okay? But you still have less money than you had last year, even though it's the best performer, because it lost so much. It's got to make almost 60% to get people back to even.
Yeah. Well, again, if you want to have a better understanding of your money, ladies and gentlemen, always have a resource available. Chris McIntire Retirement Services, and you can get your game plan for retirement put together. An analysis of your current investments and retirement accounts, the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, and make sure that your financial future is not absolutely reliant on any of these commonly held myths, misconceptions, or financial mistakes that we are reviewing today. By the way, if you would like this report of the 7 financial myths, you are also able to get that. That is available for you. All you need to do to get that complimentary review or strategy session, a review of your current plan or a plan put together, or this list to go over on your own time, pick up the phone and give McIntire Retirement Services and Chris McIntire a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, the next on this list is something that was really relied upon for maybe the last 30 years or so as people were planning for and projecting out retirement specifically, and that is how much income could be generated from an investment portfolio. I've heard this one widely debated, but the 4% rule, as it was dubbed, was generally accepted and utilized by the financial industry and the Wall Street firms.
Yeah, that's a great rule of thumb there. I think his name was Paul Bengen, I think, from California, who created the 4% rule. And, and it's a theory. It's not a law. It's a little easier now to start using that 4% rule of thumb because we've got a much better interest rate environment, right? But again, the 4% rule means you have to adjust your withdrawal rate for inflation. That's what they're taking into account. And now that we live in an inflationary environment, you have to watch pulling too much money out of your portfolio. So let's say you got $1 million and you're pulling 6% out of that. That's $60,000 a year. And as we all know, stock markets can go down. So, that can certainly upset that apple cart. If you lose 20%, now you need to pull about 8% out, or a little, close to 8%, because you got 800,000 times 8% is 64,000 and you were pulling out 60 before. So, that's the issue. And we deal with, have dealt with that issue a lot here after 2022 is, working with clients on how much they're pulling out and, can we recalculate? Can we come over here, grab some money from a safe strategy, give the investment portfolio a little time to recover after a disappointing 2022 for stock and bond investors, right?
The interest rate environment, Chris, actually does have a lot to do with this one, right?
This one, it does for sure. Yeah, because the rates went up so fast that it really hurt the bond market. So, a lot of investors, their bond prices are down in value. Those bonds are still paying the interest rate, but it looks bad on paper, obviously. Stocks also fell in value. Okay. The long-term effect of that is let's say a corporation or the government, the U.S. government is issuing new bonds. They're issuing them at higher interest rates, right? Everybody listening to this show right now knows that they can go into any bank, around the area and get a 5.5% CD right now for, maybe 1 or 2 years, that it's still a short-term interest rate piece right now. It's not necessarily long-term. And we may see that change as the Federal Reserve may eventually freeze interest rates. That's what we're getting a rally on right now. Here in the start of the fourth quarter, there's more consensus that they're done raising interest rates. Okay. And eventually they may cut later in 2024. A lot of the consensus was they would cut interest rates even this year, right? And we were supposed to have already gone into a recession. That's what happens typically when they raise interest rates, but the economy's been very resilient. Hiring's been very good. So back to that withdrawal rate, on that $1 million, if inflation is 4 and 5%, look, you're going to need double that income in about 13, 14 years. So, that's where withdrawing so much early can impact your long-term investment results.
Well, yeah, because that's another issue here, Chris, is that my bill collectors do not call me when markets are down and say, "Hey, we want to extend the offer to cut your bills as well," because we know the market and your portfolio is down. Not only that, we've got to create that consistent income month after month, but it's got to be more income that is necessary in 5, 10, 15 years. We've got to factor in inflation. That's another off list here, but another kind of common myth or misconception, Chris. A lot of financial projections for retirement fail to factor in inflation.
Yeah, exactly. And, one of our other points was talking about taxes will be lower in retirement. Okay? And I'd make the argument, well, isn't inflation a tax as well that consumers pay? Because if you're paying 20% more for a 2x4 now than you did 2 years ago, I think a lot of us would say, even Ben Bernanke, the former chairman of the Federal Reserve, said inflation is a stealth tax. So to kind of tie those two in together, taxes and inflation can sometimes go hand in hand. And we're going to be dealing with inflation here in the long run because everybody says the common consensus, when I say everybody in the financial world, is that interest rates are going to stay higher for longer interest rates will stay higher for longer to get inflation down back to that 2% target rate. And I think right now they're saying it's 3.7 to 4%. But in the United States, we don't include food or fuel in that. And, I can tell you, I just put $118 of diesel fuel in my pickup truck, and you walk in a grocery store, you come out with one bag of groceries, and somehow that's $65. It's insane right now. So yeah, inflation is something that, the retirees living on fixed incomes, are impacted the greatest by all means.
Yeah, it's inflation has been pesky here. So you've got to include that in your plans. You also have to include, ladies and gentlemen, the fact that taxation will not go away in retirement. For many of us, the retirement years are actually the highest taxed years because we're pulling money out of those tax deferred accounts. We don't have the dependents at home. We don't have the home mortgage interest tax deduction that a lot of us are using, at least right now, with the standard deduction being so high, but that could go away here in just a few short years. So taxes could be going up, in fact, in 2026. Chris, I know that you are doing a lot of proactive planning with your clients in regards to this one.
Yeah, we're a big Roth conversion type firm where, this is the time of year where we're having our clients work their way to their accountants to see if it makes sense to do some Roth conversions, take money from an IRA, move it into a Roth IRA. For our clients that are over the age of 70 and a half, they can do qualified charitable distributions. Obviously, many folks who are older are very charitably inclined. Maybe it's additional income, and that qualified charitable distribution allows them to take money from their IRA account and not pay taxes on it as long as it gets paid to a qualified charity. That's why we call it a qualified charitable distribution, a QCD, if you ever hear us on the show talk about that before.
Yeah, and one of the greatest opportunities to have truly tax-free money over our lifetime, ladies and gentlemen. So we don't want to overlook those opportunities, and Chris McIntire can help you identify when those kind of strategies and opportunities are available to you. There are a few others out there, and Chris McIntire helps his clients to realize the benefit of those all the time. And if you are missing those conversations in the discussions about your finances, your investments, your planning, that could be just the tip of the iceberg on the things that you are missing. And we also don't want you to be absolutely reliant on any of these 7 financial myths or misconceptions. And that's what we are talking about today. If you'd like this report on the 7 financial myths, if you'd like to review your plan and get that game plan for retirement, the written document put together for yourself, pick up the phone, give a call. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, I don't think we're going to have time to get to all of these today, but there is one more on this list. And when I read the report and thought about this, I tend to agree. The need for life insurance may change when I move from my working career where I've got an income that I'm trying to replace and protect, where I've got kids and I've got a mortgage. When I move to retirement, those things may go away, and therefore the need for insurance may change a bit. But I don't think the need for insurance completely goes away. I want the confidence to be able to spend my money and enjoy my time throughout retirement with my wife. And not to mention those healthcare expenses that could come up toward the end of life can be pretty extensive. There may be a continued value for life insurance even into and through retirement. It's not universal, it's not across the board, but it is definitely one to consider and rethink.
Yeah, Peter, I just attended a conference in Chicago, and we had one of our guest speakers, Tom Hegna, who you've had on the show here with us as well, who's a guru in the insurance industry. And if you haven't followed Tom Hegna, please do so on some of the web social media places, HEGNA, Tom Hegna. But Tom Hegna, he was up on stage, 300 of us sitting in an audience, and he says, if anybody says, have you ever asked anybody, what do you think about life insurance? And, they may say, well, I don't need any, and so on and so forth. And then you ask them, well, how much do you want to have on the day you die? And the answer is as much as I possibly could. So, life insurance is an income tax-free vehicle. But like you said, I loved your tie-in here is, look, a properly, done retirement plan may include some life insurance so that you can spend money early. And then when you pass away, you can replace some of that money for your beneficiaries, your spouse, your children, but allow you to live on your dollars instead of saying, well, we can't afford to do it because once we're done with this pile, we're done. Our kids will get nothing. And, some of you listening to the show today aren't worried about passing money on to your kids. Okay? But that transition usually changes in in your mid to upper 70s and 80s when you start thinking differently, because we go into different phases of life, and I say that with parents that are 86 and 90 and a 94-year-old father-in-law,
Yep. No, needs change, desires, goals with our money. And it may not be a big goal to pass a great amount of wealth down to the next generation. I don't think that's a selfish notion at all. But in all reality, if we've taken care of assuring ourselves that we will be self-sufficient throughout our retirement, then likely something will be passed on, at least a positive kind of impactful legacy. And that's ultimately, I think, what we desire is that we can spend our money with confidence. And sometimes there could be a time and place where life insurance plays a part in that. It's not, again, universal across the board, but let's rethink this myth of I do not need life insurance in retirement, because it can add a great deal of spending confidence to enjoy your money together. And again, Chris can provide for some of those long-term care expense protections, which are kind of the elephant in the room there. But anyway, again, I don't think we're going to have time to unfortunately cover all of this list of the 7 myths, but I think each one of the 7 items on this list are important. So ladies and gentlemen, pick up the phone, give a call, request this list of the 7 common financial myths, misconceptions, and planning mistakes, and go over it on your own to see if maybe your financial future is reliant on any of these. And if so, if you've got any questions on if so, give McIntire Retirement Services a call and set up that complimentary review retirement planning strategy session. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, it is always a pleasure to have you on the program. You always bring some great information for the listeners, for the proactive savers and investors across Northwestern Ohio.
And my pleasure, Peter. Thanks for listening, everybody. Enjoy your week.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntyre. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.